You are welcome to my YouTube channel today. If this is the first time of you coming across my lecture, please don't forget to like the video, also share it and subscribe so that you don't miss my upcoming videos. Thanks for watching EZIKAN. So in today's class, I'll be examining group accounts. Group accounts or consolidated financial statements. Group accounts or consolidated financial statements. Introduction to group account. What do we mean by group? Group comprises the parent and the subsidiary or subsidiaries. The parent and the subsidiary. The parent company is also called the holding company. Holding company. Parent company is an entity that controls other entities. An entity that controls other entities, known as the subsidiary, is known as the parent. Parent company control the subsidiary companies. Parent control the subsidiary company. While the subsidiary company is an entity that is controlled by the parent. If you look at the keywords, is control. An entity that is controlled by the parent is said to be the subsidiary. A parent is presumed to gain control of the subsidiary when the parent company acquires more than 50% of the ordinary shares. 50% of the ordinary share. Ordinary share of the other entities. Or other entity. Or other entities. When the parent acquires more than 50% of the other entities known as subsidiary, that parent is said to gain control of the subsidiary. Therefore, what do we mean by control? In accordance with IFRS 10, Consolidated Financial Statements. IFRS 10. Control. An investor controls an investee. An investor controls an investee. When the investor is exposed or has rights to variable returns from its involvement with the investee. When the investor is exposed or has rights to variable returns from its involvement with the investee and has ability to affect those returns through its power over the investee. I've told you that in accordance with IFRS 10, IFRS 10 define control as control. In accordance with IFRS 10, an investor controls the investee. When the investor is exposed or has rights to variable returns, variable returns from its involvement with the investee. With the investee and has ability to affect those returns through its power over the investee. That is IFRS 10. That is control in accordance with IFRS 10. Control. An investor controls the investee. When the investor is exposed or has rights to variable returns from its involvement with the investee and has ability to affect those returns through its power over the investee. That is control in accordance with IFRS 10. I've told you that the parent company, that is the holding company, will control the investee when the holding company acquires more than 50% of the ordinary shares of the investee. When the parent company acquires more than 50%, not exactly 50%, not exactly 50%, more than 50%, that is from 51% upwards. So when the investor acquires more than 50% of the equity interest of the investee, that investor becomes the parent company. Definition of terms. Definition of terms. Number one term we are going to examine is retained earnings or retained profits. Retained earnings of the subsidiary or retained profits of subsidiary. This is the accumulated profits of the subsidiary. The accumulated profits of the subsidiary is said to be the retained earnings. These profits will be divided into two: the pre-acquisition period and post-acquisition period. The one related to the pre-acquisition period, we call it pre-acquisition profits or pre-acquisition retained earnings. And the one relating to post-acquisition period, we call it post-acquisition profits or post-acquisition retained earnings or post-acquisition reserves. Either reserves or profits or earnings, they are all the same. Any of the terms may be used. Pre-acquisition profits is the profit of the subsidiary as at the date of acquisition. The profit of the subsidiary as at the date the subsidiary were acquired by the parent is known as the pre-acquisition retained earnings. These are the profits that have been earned by the subsidiary company before that subsidiary company were acquired. This profit has been earned. Because it has been earned, such profit will not be available for distribution to the shareholders of the parent company. That is why pre-acquisition profit will never be shared between the parent and the NCI. Because those profits have been earned before they were acquired by the parent. They should therefore be included in the cost of control. They should be included in the calculation of goodwill. Pre-acquisition profit should be included in the calculation of goodwill, but they should not be distributed. They should not be shared to the parent company will not receive the share of pre-acquisition profits. I've told you that these are profits of the subsidiary as at the date of acquisition. Examples of pre-acquisition reserves include profit, which is revenue reserves. Revenue reserves. You can have that. You can also have a share premium. The share premium as at the date of acquisition. The share premium as at the date of acquisition. So all these reserves should be included in the calculation of goodwill. At least they should be included in the cost of control. Then post-acquisition reserves. This is an increase in reserves. It's an increase in reserves of the subsidiary which arose after the acquisition or which arose after acquisition by the parent company. Increase in reserves of the subsidiary company which arose after acquisition by the parent company is known as post-acquisition reserves or post-acquisition profit or post-acquisition retained earnings. Increase in reserves of the subsidiary which arose after acquisition by the parent company. Meaning that since these reserves arises after acquisition, that means they relate to the post-acquisition period. Since it relates to the post-acquisition period, they should therefore be shared between the shareholders of the parent company and the non-controlling interest. So meaning that the parent company will receive share of the post-acquisition profits. Post-acquisition profit will be shared among the parent company or between the parent company and the non-controlling interest. Should take note of that. Now, to calculate the post-acquisition retained earnings or post-acquisition reserves, you have the accumulated reserves of the subsidiary. Accumulated reserves of subsidiary as per statement of financial position. You take that. Then you now deduct pre-acquisition reserves. So when you deduct pre-acquisition reserves from the accumulated retained earnings of the subsidiary as per the statement of financial position, then you are going to get the post-acquisition reserves or post-acquisition retained earnings. Take note of that. That is number 1 term. Then number 2 term I'm going to examine is net assets. Net assets. The simple definition of net asset is equity, meaning that net asset is equal to equity. Net asset equal to equity. That is, net asset equal to total assets minus total liabilities. Total asset less total liabilities. That will give you the net asset. Total asset less total liability will give you the net asset. Or you can just say net assets are equity. Hitherto, I'll be adopting this definition. So anytime I mention net asset, just have it in mind that bear it in mind that I'm referring to equity. So net assets are equity. So if net assets are equity, so what is an equity? In accordance with the IASB conceptual framework, the framework defines equity as the residual interest in an asset of an entity after deducting all its liabilities. After deducting all liabilities. The residual interest in an asset of an entity after deducting all liabilities. That is equity. So for better understanding, you can watch my presentation on IAS 1. So if you need more explanation on equity. So in that note, I've told you that equity has 2 components. There are 2 components of equity. We have the share capital. The share capital and the reserves. These are the 2 components of equity. So if I make mention of equity, or if I mention net asset, just know that I'm referring to equity. And if I'm referring to equity, I'm referring to all these items together: the share capital and reserves. So the reserves may include the retained earnings or retained profits, retained earnings or retained profits. Then you may also have the share premium. Share premium is also one of the components of equity, which is also a reserve. Then we also have other components of equity or revaluation reserves. Revaluation reserves. So we have these So I'm going to categorize reserves into 3. Retained earnings as number 1, share premium as number 2, and revaluation reserves as number 3. So I have these 3 items as the breakdown of our reserves. Then share capital. So we have ordinary share, and then irredeemable preference shares, irredeemable preference share. I have this as the 2 classifications of share capital I've been referring to as the component of equity. So your total assets less total liabilities is equity. Equity equal to total assets less total liabilities. Remember, I told you that net asset is the same as equity. If net asset is equity and net asset is total asset minus total liabilities, that means equity is equal to total asset minus total liabilities. Therefore, now, that is equity or net asset. The number 3 elements I'm going to consider is goodwill. Or before I talk about that, let me consider the investment in subsidiary. Number 3 element I will consider is investment in subsidiary. That is investment by the parent company in subsidiary company, or purchase consideration. Purchase consideration. What do we mean by purchase consideration or consideration transferred? This is the price paid by the parent company to acquire the shares of the subsidiary company. The price paid, consideration is the price. The price paid by the parent company to acquire its shares, or the shares the parent company acquired, to acquire it from the subsidiary company. The price paid to the shareholders of the subsidiary in order to acquire the shares of the subsidiary. That is the purchase consideration, which will be shown as investment in subsidiary in the parent company separate financial statement. Now, number 4. This purchase consideration may be given directly in the question. I may be given the information to calculate it. So we are still going to examine. Okay, I'm going to categorize this consideration into 4. Number 1 is cash consideration. Number 2, we have deferred consideration. Number 3, we have share consideration or share exchange. Share consideration. Another word for share consideration is share exchange. And contingent consideration. But my focus for now is on cash consideration. Other forms of purchase consideration will be considered in my later videos. So, I've told you that purchase consideration is the price paid to the shareholders of the subsidiary company by the parent company in acquiring the shares of the subsidiary company. So that is purchase consideration. Now, the number 4 term I'm going to examine is goodwill. What do we mean by goodwill? You know, when parent company acquires the subsidiary company, what parent is acquiring from the subsidiary is their assets and liabilities. Parent company is acquiring the assets of the subsidiary and the liabilities of the subsidiaries. If the parent company is acquiring the assets and liabilities of the subsidiary, at the end of the day, you are going to net it. Asset minus liabilities. You know, assets less liability, that is equity. That means the parent company is acquiring the equity of the subsidiary company. If the parent company is acquiring the equity of the subsidiary company, that means it is possible the equity worth of $10 million may be acquired, and the parent company might pay, let's say, $12 million for such equity. You know, the equity acquired actually worth 10 million, and the price paid by the parent company to acquire such equity is 12 million. The price paid to acquire the equity is more than the worth of that equity. By how much? By 2 million. 12 million minus 10 million, which is 2 million. That 2 million is goodwill. So, what is goodwill? Goodwill is the excess of purchase consideration, which we have considered in number 3, over the fair value of the net assets of the subsidiaries acquired. Goodwill is the excess of purchase consideration. This 12 million is the purchase consideration, that is the price paid, over the fair value, the market value of this 10 million. How much is the actual worth of it, which is its fair value? The actual worth of the 10 million equity shares is its fair value. The price paid is 12 million. Excess of the purchase consideration over the fair value of the net identifiable asset of the subsidiary acquired is goodwill. That is why I said goodwill is the excess of purchase consideration over the fair value of the net assets acquired. High title to calculate goodwill. Goodwill have purchase consideration. You have the non-controlling interest, where it is partial acquisition, non-controlling interest. Now less fair value, FV fair value of net assets at the date of acquisition. I'm still going to give you the summary of the net asset, how to arrive at this. So you arrive at goodwill. This is goodwill. And the goodwill should be subject to an impairment review. And when you have impairment loss on goodwill, you deduct that. So when you deduct that, you arrive at the consolidated goodwill. This is the goodwill that will appear in the consolidated statement of financial position. But where there is no impairment loss, this is the amount we are going to record in the consolidated statement of financial position. So, excess of purchase consideration over the fair value of the net identifiable assets acquired, that is goodwill. Now, that is number 4. Number 5 now, I'm going to consider non-controlling interest. Non-controlling interest. Number 5, non-controlling interest. I want you to note that we only have non-controlling interest in the case of partial acquisition. You only have non-controlling interest in the case of partial acquisition. Partial acquisition in the sense that where the acquisition is in part, where parent company acquires part of the equity shares of the subsidiary, not everything that were acquired. But where the acquisition is 100%, there will be no non-controlling interest. So, what do we mean by non-controlling interest? I've told you that where from 100%, if parent acquires only 80%, the remaining 20% not acquired by the parent is the non-controlling interest. High title to abbreviated as NCI. NCI, the 20% not acquired by the parent is non-controlling interest. Therefore, non-controlling interest is the part of the equity interest of the subsidiary which are not acquired by the shareholders of the parent company. That part of the equity interest of the subsidiary which are not acquired by the parent company is known as non-controlling interest. the part of the equity interest of the subsidiary which does not belong to the parent, which are not acquired either directly or indirectly by the parent company, is known as non-controlling interest. I repeat, the part of equity interest of the subsidiary which are not acquired either directly or indirectly by the parent company, that is non-controlling interest. In accordance with IFRS 3, IFRS number 3, we have two ways of valuing non-controlling interest. Valuation of non-controlling interest. We have two ways of valuing NCI, non-controlling interest. Number one is proportionate share of net assets. Proportionate share of net assets method. That is, you apply a proportion, you share the proportion of net assets of the subsidiary, you share it. Net assets. And the second method is fair value method. Fair value method. Another word for fair value method is full goodwill method. Full goodwill. Full goodwill method. Full goodwill method. And another word for proportionate share of net asset method is partial goodwill method. So, I've told you that non-controlling interest, I say, is the part of the equity interest of the subsidiary which are not acquired either directly or indirectly by the parent company. So, proportionate share of net asset method. Under this method, non-controlling interest is valued by applying the percentage attributable to non-controlling interest on the fair value of net assets of the subsidiary at the date of acquisition. You apply the percentage attributable to non-controlling interest on the fair value of the net assets of the subsidiary at the date of acquisition under the partial goodwill method, that is proportionate share of net asset method. If NCI is 20%, you have 20% times net assets at date of acquisition. That is under this method. NCI is valued by applying the percentage attributable to non-controlling interest on the fair value. You have to make use of its fair value. Fair value of the net asset of the subsidiary at the date of acquisition. That is under proportionate share of net asset method. So, under the fair value method, the NCI is valued by applying the percentage attributable to non-controlling interest on the full or fair value of the subsidiary. I didn't say fair value of net asset. You should not confuse them. They are not the same. Fair value of the subsidiary is different from fair value of net assets. Net asset, you have to reinstate the net asset in the stable financial position. Reinstate them to their fair value by considering the fair value gain or deficit. You adjust for those items. So that is fair value of net asset. But this one now, you make use of the market value of the subsidiary. The non-controlling interest is valued by applying the percentage attributable to non-controlling interest on the market value of the subsidiary, not the market value of the net asset. Please take note. I said the market value of the subsidiary. I didn't say the market value of the net asset. I repeat, the market value of the subsidiary. The market value of the subsidiary is the same as the fair value of the subsidiary. You apply the percentage attributable to non-controlling interest on the fair value or market value of the subsidiary. That is under the fair value method or full goodwill method. Please take note of that. Now you have different ways the question may be examined. Under this, you may be given the fair value of non-controlling interest in the question, and where the parent company policy is fair value and the fair value of non-controlling interest is given, then you can apply that directly. That one is not difficult. But in some cases, you'll be given the market price per share of the subsidiary. Market price per share of the subsidiary. In that case, you have 20, let's assume NCI is 20%. You have 20% times market price per share of subsidiary, market price per share of subsidiary times the number of shares, total number of shares of the subsidiary. Market 20% percentage attributable to NCI times market price per share of subsidiary. Note the market price per share of subsidiary times total number of shares of subsidiary. That will give you the total market value of the subsidiary. Then you now apply the percentage attributable to NCI on that. That will give you the NCI at the date of acquisition. That will give you the fair value of non-controlling interest. In accordance with IFRS 3, so these are the two policies that holds on NCI, and this policy will equally affect the calculation of goodwill. I want you to note that the goodwill calculated under the fair value method will be greater than the goodwill calculated under the proportionate share of net asset. The amount by which the goodwill under the fair value method exceeds the goodwill under the proportionate share of net asset is called goodwill, is the goodwill attributable to non-controlling interest. Meaning that the goodwill under the fair value method is recognizing two different types of goodwill. Fair value method, the policy under this policy is recognizing two types of goodwill. Goodwill attributable to parent, goodwill attributable to parent, and goodwill attributable to NCI. These are two forms of goodwill recognized under this fair value policy. But proportionate share method only recognizes goodwill attributable to parent. Proportionate method recognizes goodwill attributable to parent. Meaning that if you calculate goodwill under the fair value method and you calculate goodwill under proportionate share of net asset method, if you subtract this one from this, the amount by which this exceeds this is the goodwill attributable to, is the amount of fair value of goodwill attributable to NCI. The amount by which the goodwill under the fair value method exceeds the goodwill under the proportionate share of net asset method is the amount of goodwill attributable to NCI. I want you to take note of that. Now, having examined goodwill, then the number, I think I'm on number 6. Gain on bargain purchase. Gain on bargain purchase. Gain on bargain purchase can also be called negative goodwill. That is, when the fair value of net asset acquired exceeds the purchase consideration, then you have the gain on bargain purchase. That is, the calculation of goodwill turn out to be negative. You are going to calculate it the same way you calculate your goodwill, the same format, the same formula. Only that the calculation of goodwill will be negative. And where the calculation of goodwill is not negative, in accordance with IFRS 3 business combination, your negative goodwill should be called gain on bargain purchase. Number 7. Okay, these are the terms that will be used hitherto in this lecture. What are the steps for preparing consolidated statement of financial position? Now, before I go into the steps, what do you mean by consolidated financial statement? Consolidated financial statements. Consolidated financial statements is the financial or are the financial statements of the group. Consolidated financial statements are the financial statements of the group presented as that of a single economic entity. The financial statements of the group presented as that of a single economic entity. Now, when you are preparing your consolidated financial statement, you'll be adding line by line the individual items in the parent company financial statements with that of the subsidiary company after eliminating the intra-group balances. You add line by line the items in the parent company financial statements with that of the subsidiary. You eliminate the intra-group balances. So when we proceed, then I'll be explaining what intra-group items or balances mean. Now, what are the steps for preparing the consolidated financial statement? Step number 1, you draw the group structure. Draw the group structure. Group structure explains the relationship between the members of the group, whether it is a simple group structure, whether it is one parent and one subsidiary, simple, that is where you have one parent, one subsidiary, that is simple group structure. Or one parent, one subsidiary and associate, or where you have fellow subsidiaries, or where you have sub-subsidiaries, or where you have D-shape or mixed group. So we'll be considering each of these one after the other. Now, you draw the group structure, e.g., H acquired 70% of equity shares of S. So to draw the group structure now, you can have H acquires 70% of equity interest of X. Or you draw it, H acquires 70% of S. That is simple group structure. You draw the group structure. That is the first step. Step number 2. Step 2. Present the summary. Present the summary of the subsidiary net assets. Present the summary of the subsidiary net assets. So you can have summary of S net assets. So you can have post acquisition, retained earnings, then you can have date of acquisition, then date of consolidation. This date of consolidation is a memorandum column. It only shows the transfer. All items will be in this column and they move from here to either this or this. So I've told you that net assets are equity, and I've told you that equity comprises your ordinary share. The one you just lift, the figure you have in this column now, I'm lifting them directly from the statement of financial position of the subsidiary. Then share premium, if any, share premium, we are lifting it from the subsidiary statement of financial position. Then you have retained earnings, if any. You are lifting that from the subsidiary's statement of financial position. Your net assets here, I've told you, your ordinary shares here. So what you have here is usually what you'll be having in DOA, date of acquisition. DOA means date of acquisition, while DOC means date of consolidation. Now, the reason is that hardly will you see any question where the entity will have further issue of shares after acquisition. Hardly will you see a question that will involve where subsidiary will issue further shares after the acquisition by the parent. So, for examination purpose. Now, if this and this are the same, then this man on the post-acquisition will be nil. Then share premium. No, you have your share premium when you issue shares. Since there are no issue of shares after the acquisition period. No issue of shares related to post-acquisition period. So that means the share premium will also relate to pre-acquisition period. So you will not be having that in post-acquisition. It will also relate to the pre-acquisition period, I mean. So you will not be having any in post-acquisition period. Then retained earnings. In some cases, you may be told that subsidiaries were acquired at the date of incorporation. If subsidiaries were acquired at the date of incorporation, that means there will be no pre-acquisition profits. But if it was acquired sometimes ago, you may be given the profit relating to pre-acquisition period. And in some cases, the pre-acquisition profits will not be given. You will need to calculate that yourselves. So I will explain how to calculate that because it depends on the way the question is structured. So the pre-acquisition profits, so you have it here. If you deduct the pre-acquisition profit from the accumulated profit, the DOC, then you have the post-acquisition profits. Now, my teaching method, I normally adjust for all the items that will have their impact in profit or loss. I normally adjust them in the summary of net asset. That is my teaching method. I'm not saying this is the only way the items can be treated, but we have alternative treatment. So, but my teaching method, I normally adjust them here for the sake of simplicity. The reason for that is that I want to simplify it as much as possible so that I will not be giving students unnecessary headache. So that is why I normally adjust all items that affect profits or loss. I normally adjust them here. Number one, I want to talk about impairment loss. In accordance with IE 36, impairment of assets. It said impairment loss is where the carry amount of an asset exceeds its recoverable amount. So that has been explained in a separate video. So for better understanding, I have all my lectures on my YouTube channel, and I have an organized playlist. I have on different courses: financial reporting, performance management, corporate reporting, SBR, strategic business reporting, and strategic financial management or financial management, tasks, and other courses. I have courses in all this. So you have them here. I also have another YouTube channel, ZICA and Journey, but that one is for gospel music. Please, I want to also show the same love you have shown me in EZIKAN Academy YouTube channel. So also extend that love to me by subscribing to EZIKAN and Journey YouTube channel. It's my channel for gospel music, and I want you to be listening to the songs as well. So God will help you and God bless you as you do so. So now, impairment loss. Remember, I've told you that we have two policies as regards the fair value. NCI, proportionate and fair value. Where the policy is fair value, I've told you that the fair value method recognizes two different types of goodwill. The one belonging to the parent and the one attributable to NCI. So, in that case, where the policy is fair value, the impairment loss will be shared between the parent and the NCI. So, for the sake of simplicity, instead of sharing them, I'll be adjusting that in our retained earnings. It's the same with if you apply the percentage you share between parent and NCI, you adjust it in retained earnings of parent, you adjust it in NCI, so it's still the same. But I will just be putting that here so that you know that you will not be bothering yourself with that again. So we have impairment loss. I've told you that we only have impairment loss here in the summary of subsidiary net asset, where policy is what? Policy is fair value. So, impairment loss will relate to the post-acquisition period. Then, you can also have intra-group transfer of inventory, which will result in an unrealized profit. Provision for unrealized profit. Transfer of inventory. Provision for unrealized profit on transfer of inventory. You will only have this here also where subsidiary is the seller. Where subsidiary is the seller. Where parent is the seller, you don't need to adjust that here. So take note of that. Then we also have fair value adjustment. Let me say fair value gain of the subsidiary, where subsidiary assets are fair valued. The fair value gain should be added to the DOA. Then, where the asset that is fair value is a depreciable asset, then you can have extra depreciation on fair value gain. I want you to know that fair value deficit is the opposite of fair value gain. If it is fair value deficit, you are going to subtract it here. Extra depreciation, you are deducting depreciation. So, this depreciation will be calculated from the date of acquisition to the date of consolidation. You count the number of months or years from the date of acquisition to the date of consolidation. I want you to take note of that. Where it is fair value deficit, it is the opposite of that. These are the major items I will consider here. So this is the summary of the net assets. This is the summary of the net assets. Now, step 3. Calculate goodwill. Calculate goodwill on acquisition. I've given you the format for calculating goodwill earlier. I've given you the format. I've told you that you have your purchase consideration or investment in subsidiary or consideration transferred. You add your NCI at the date of acquisition. I've told you, I've explained the two methods of calculating NCI. Then you deduct the fair value of net assets at the date of acquisition. So you arrive at the goodwill. Then you deduct the impairment loss. You arrive at the consolidated goodwill. Fair value of net assets at DOA is the amount you have arrived at here. The amount you arrive at here. Summary of the net asset. The column of DOA, the total there, is what you have here. Then, 4. You calculate non-controlling interest. Non-controlling interest. Calculate NCI that will appear in the consolidated statement of financial position. NCI will be NCI at acquisition. The same amount you have here. So it's what you are going to have here. Then you now have NCI, share of post acquisition retained earnings of subsidiary. So you have the amount of NCI that will be consolidated. Number 5, you have your retained earnings. Your retained earnings. You have parent retained earnings as per statement of financial position. SOFP, statement of financial position. Then you also add parent share of post acquisition retained earnings of subsidiary. When you add that, then where the policy is proportionate, you deduct your impairment loss here. Impairment loss, where policy is proportionate of net asset. You deduct your impairment loss. Then provision for unrealized profit on inventory. where policy is proportion, where subsidiary, parent is the seller, where parent is the seller. Remember I told you where subsidiary is the seller, you adjust that in the subsidiary net asset. Then you arrive at the consolidated retained earnings. So these are the steps. The step 6 is to prepare the consolidated statement of financial position. Don't forget, you eliminate the intra-group items when you are preparing your consolidated financial statement, because the connected parties, they can easily be influenced. The connected parties transactions can be influenced easily. So that is why the framework was trying to ensure that the consolidated financial statement, the impact of related party transactions are eliminated. They want to ensure that the impact of related parties transactions are removed from the consolidated financial statements, so that the financial statement cannot be manipulated to suit the needs of the group. So that these are the steps we need to follow. My next video, I will take a work example, and I will also explain other concepts which I have not examined. Please don't forget to like the video, also share it with others so that the video will be able to go viral. Thanks for watching EZIKAN.